Good evening. This is Greg Giardino with Atlas Fiduciary Financial, and we're really glad you could join us this evening here on Election Day. But tonight is all about tax smart planning. And studies show that those folks that work with a financial planner that do any type of tax efficient planning can reap huge benefits. So for example, if you look at a Vanguard study or the Russell Investment study, they've shown that if you can do certain things such as asset location, which is taking tax inefficient investments and putting them in the right place for tax efficiency, as well as when you retire and you take $1 out of your retirement plan, if you take it in a very tax mindful manner, it can add up to roughly, according to the Vanguard study, 180 basis points per year in value. So on $1 million portfolio, that can be up to $18,000 per year in maximum value just from tax planning alone. So as you can see, tax planning is a big deal. And I thought it'd be a really great idea to take you through our process in reviewing a tax return, so you can get a bird's eye view of a sample professor tax return and what we look at as a financial planning team here, as well as showing you the tax report that we deliver to our clients with different observations and recommendations so that they can be more mindful and mitigate their taxes. And then finally, I'll review with you our tax planning software, and I'll take you through a scenario or two so that you can see the power of some of the tools that we use. And it's going to be jam-packed tonight. I'm going to try to keep it to 20 minutes or so, but make sure you stay until the end where I can answer all of your questions in a live Q&A session. And before we begin, quick disclaimer, the information presented tonight is for general information purposes only. If you're looking for specific advice, specific tax advice, please speak with your tax, legal, or financial advisor. So now that we have that out of the way, I will pull up the sample professor tax return. Bear with me here. All right, so as you can see here, this is the 1040 for Peter and Paula professor. As you can see, we're not too creative here. We try to keep things simple, but let's just go through this rather quickly. And once again, I'm not going to go through the whole tax return here. I'm just going to focus on page 1 and 2. And going back to Peter and Paula, they are both medical professors at the University in Texas. They're both 61 years of age. And as you can see at the top here, they are married filing jointly. So generally speaking, those that are married filing jointly will pay the lowest amount of tax from a tax perspective, generally speaking. Now, you may want to do married filing separately on very rare occasions, whether there is a impending divorce, whether your significant other, their tax return documents are not up to par, and you want to disengage from them. That would be the only reason to do married filing separately, but I digress here. But for all intents and purposes, they are married filing jointly. Moving here down the tax return, I really want to get into the meat and potatoes of the income sources and how we look at certain important line items here on the tax return. So as you can see here on line 1, both Peter and Paula make $300,000 in salary from the university. So Peter and Paula, they make $150,000 each in salary at the medical center. And then lines 2 and 3 really deal with interest and dividends. So if you own any investment accounts that are outside of the university, so if you have a Charles Schwab account, if you have a Vanguard account and they own stock and bond funds, they may generate interest or dividends. So as you can see here on line B, they have approximately $12.50 in interest that's coming from their bank accounts, their CDs. So that will be flowing onto their tax return that they have to pay tax on. And then for part 2A here is tax exempt interest. Sorry, my highlight is highlighting everything here, but tax exempt interest would be things like municipal bond interest. Now, a common error that I see sometimes on different tax returns, especially here in the New Jersey tax return area, is with municipal bonds, their interest on the federal level is tax-free. And on the state level, it can be tax-free as well if you reside in the same state as the issuer of the municipality. So if I have a New Jersey municipal bonds, then, and I live in New Jersey, the interest should also be state tax free from the New Jersey tax level. And sometimes I see that missed. It's not a big thing, but when I review tax returns, it's something that I usually find. Now, in regards to dividends here on line 3A, there's basically two types of dividends. And let me take a step back. A dividend, if you own a stock or a company, it's simply a distribution of the company's earnings to you. And if you own a bond or a bond fund, they can also pay a dividend in the form of interest back to you. And dividends can be one of two different types. They can be either qualified or what's called ordinary dividends. And the main difference is ordinary dividends are taxed at those higher ordinary income tax rates. So up to that 30% top rate, where qualified dividends are taxed at a more preferential rate, usually 0, 15, or 20%. So that's the main difference between the two. And it can be a little confusing here on this tax return because you could see 15,000 in ordinary dividends and 11,500 in qualified dividends. So one may assume, well, if you add 11,500 plus 15, I have 26,500 in total dividends. That is not the case. 15,000 is the total amount of dividends, and 11,500 is the portion of the 15,000 that is taxed at the qualified rates. So keep that in mind. Moving along here, Paula did an IRA distribution of about 25,000. She did a Roth conversion. I won't go into the specifics of that, but basically that is a taxable event. And out of the 25,000 that she did, only 15,750 was taxable. So that will flow through as income on the tax return. On line 7, that is for any capital gains or capital losses. So once again, any accounts outside your 401A, your 403B from the university, if they're in after-tax accounts, if they're in brokerage accounts, and you sell them for a gain, well, you'll have to realize that as income. So Paula sold some investments. She had about 31,500 worth of capital gains. And then on line 8, Paula also happens to be a very successful food blogger. She has an online blogging business, and she brings in about 40,450 every year. So that gets reported as well. So if you take lines 1 through 8, you total them up, you get total income of 403,950. So this is an important line to look at. As I mentioned, this is also known as gross income, your total income. And a mistake I see made with many academics is they'll say, well, Greg, my total income is 404,000. If I look at the 2021 tax brackets, well, between roughly 329,000 in tax in income to 419,000 in income, well, I have 404. I should be in the 32% tax bracket. That is not the case. In fact, your gross income does not determine your tax rate. It is your taxable income. On line 15, which is here, that's the number that gets run through the tax brackets that determines your tax rate. So frequent mistake that I see, keep that in mind when you're looking at your tax return. And then once we have your total income, we can subtract some various deductions. If you contribute to a health savings account, Paula contributes 2,000. There's also some self-employment taxes that can be deducted for a total of 4,900, we'll call it. And then we come up with your adjusted gross income. I'm going to try to highlight it here of 399,000 and change. So this is a really important number to pay attention to. This is your line 11 adjusted gross income. Why is it so important? Well, it's really your starting point for calculating your taxes. So this number really flows through a lot of different things in a lot of different areas. So for example, different tax deductions, different phase out ranges for retirement plans. If you want to contribute to a Roth IRA, if you want to make a deductible IRA contribution, that flows through this number. And even some hidden taxes flow through this number, and they're keyed off of this number. So for example, for those that are getting closer to retirement, those dreaded IRMA income-related monthly adjustment amount Medicare surtaxes that get levied on your Medicare Part B and Part D premiums are keyed off of this number. And in addition, there's what's called a 3.8% net investment income tax that is also assessed off of this number. So it's really important, all things being equal, if we can drive this number lower, presumably or theoretically, we should pay a lower overall tax bill. So that's a really key number to focus on. And then once we have that number, we can take either the higher of the standard deduction, which is $25,100 in 2021, or we can take the itemized deduction, whichever is greater. So in this case, they have a lot of itemized deductions. They contribute to charity. They have mortgage interest that they write off, as well as property taxes. The most they can do is $10,000. So that all adds up to about $32,500. And then we have some other deductions here. And then, as we mentioned before, we can get the total taxable income after those deductions of $361,840. So that's ultimately the number that gets run through the ordinary marginal income tax brackets. And if we move to page 2, and I'll move through this rather quickly, we have the tax up to this point is about $71,824. We have some child tax credits. We have some non-refundable credits, some other taxes. So the total tax due is on line 24. That's $79,590. How much withholding did Peter and Paula do for the year? That was $17,000. So if they were going to do any estimated taxes, that would be on line 26 here. Now, a lot of academics don't realize this, but when they retire, they may be subject and start doing what's called estimated taxes. So usually their employer, the university, they don't have other sources of income besides their salary. Their employer takes care of withholding for them. However, once you're retired, you may be subject to estimated withholding, and it's a totally different ballgame. Now, the total tax owed here is $62,590. So hopefully this gives you a better overall view of how we look at the tax return and some things you should be paying attention to. And I think that will be a nice natural segue to our tax report. So I will share that with you now. Alrighty. So you can see here, we have our tax report, and we can kind of breeze through this a little bit quicker because we reviewed the tax return. We have a better understanding of what some of these terms are. The one thing I will point out is the total tax here that was owed, as we saw in the tax return, was $79,590. We take that number, and if we divide it by the total income number, which is $403,950, my highlighter can go across here, you can actually come up with your average tax rate or your effective tax rate, which, as we can see on the report, is about 19.7%. So even though Peter and Paula were in the 24% tax bracket, it's not a flat tax. We have a very progressive tax system. So for example, on amounts between 0 to 19,000 roughly of taxable income, you may have to pay 10% on that bracket. And then from 19,000 to 81,000 of taxable income, you may be paying 12% in that tier. So it's a graduated tax system, and it will be prorated proportionately. So you don't always pay a flat 24% tax. We have some other items here that we talked about. I'm going to skip down here really quickly. As you can see, we have the marginal tax bracket here, that they actually fell into the 24% marginal tax bracket, not the 32%. So that's good to know. And if they have any capital gains, well, we can look below here and see that they'd be taxed at a 15% rate. And on the right-hand side, this chart is really, really valuable. This is the modified adjusted gross income tier. So basically what this says is, what are some of the eligibility, the phase outs for contributing to different retirement plans and getting different credits based on your modified adjusted gross income, that line 11 that we just spoke about, plus some additional exclusions and things of that nature. So we could see here the net investment income tax, that's an extra 3.8% tax assessed on passive income. If you're over the limit of 250, you're going to be assessed that penalty. So as a financial planning team, we try to look at that to minimize the income to get it under that level. Can we contribute to a Roth IRA? We cannot because we're 198,208. You have to be within that range. They're clearly over that range. And some other interesting credits and deductions that maybe they could have been able to take advantage of. Moving along here, itemized deductions. We had 32,500 as we spoke about before. And on this left-hand side, this is very important. This is the IRMA Medicare surcharges for Part D and Part B premiums. So the thing to note here is these additional taxes are assessed 2 years in arrears. So even though the tax return here is for 2021, they will not see these additional expenses in their Medicare Part B and Part D show up until 2023. And the other thing to note is that this is a tax cliff. Greg, what do you mean by that? So what I mean is if you're $1 over these tiers, these income thresholds, you see the 366, if you have 366,001 $1 over that amount, you will be assessed that extra $110 a month on your Medicare Part B and the extra $19 a month on your Medicare Part D premium. So as you can see, it could be very onerous. And for both spouses, if they're on Medicare, that's charges for both of them. Moving forward, we could see the capital gains and losses. It's always important to see if there's any losses we can realize for the year and offset them against gains. That can also save you additional money in your pocket. And this Schedule B part is also interesting to look at because we can see that for Peter and Paula, between their Vanguard and Schwab accounts, they have about $15,000 in income coming in. Now, that idea of asset location, there may be an opportunity if they own taxable accounts, which it's showing they do, perhaps we want to own them in their 403B or 401A, or own them in their Roth IRA or a regular IRA. Because if we do, we will not recognize that income every year and be forced to pay taxes on them. So that's an analysis that we run here at our team here at Atlas. And moving along, we have other observations that Peter and Paula may want to take advantage of. I've blacked some out. Some are not important, but I wanted to go over some of the main things here. We want to be looking at the 3.8% net investment income tax, try to keep the taxable income, adjusted gross income under the 250,000 threshold so that we don't get assessed that tax. They're in the 24% marginal tax bracket. They may want to consider a Roth conversion. Roth conversions have gotten a lot of press. The whole idea behind them is take some of your money that's never been taxed before in your IRA or 403B, pay taxes on them now at potentially a lower tax rate as you would later on in life when taxes may be higher. So essentially you're prepaying taxes now at a lower rate to save on your lower lifetime tax bill later on. And then also some other observations. Make sure you're reviewing all your pre-tax options. Are you maxing out your 403B plan? Are you maxing out your 457 plan? Are you driving your AGI and taxable income down with a health savings account? You can contribute $7,200 for a family here in 2021. Also, health savings accounts are triple tax preferenced. It's a very unique vehicle. And basically, you get a tax deduction on any money that you contribute. While it's growing, you're not taxed on those dollars. And when you pull money out and you withdraw them, you're also not taxed, provided they're spent on qualified medical expenses. So this can be a tremendous vehicle to contribute to if it makes sense for your situation. This report also gives some New Jersey tax hints. It's good to note here that Social Security benefits are not taxed at the New Jersey state level. I believe there's 13 states that do not tax Social Security. That do tax Social Security. New Jersey is not one of them. So that's more benefit in your pocket. And then another thing to note here is that your 401A and your 403B contributions, they are taxable at the New Jersey state level when you make those contributions. So if you've been working at the university for, say, 30, 40 years, and you've contributed, let's say, $1 million into your 401A, well, come tax time, when you distribute those dollars, if you're not qualifying for any exclusions well, then you'll have to pay state tax on the excess on not only above those contributions, but you'll be assessed New Jersey state tax on those contributions. So in effect, you'd be double taxed. So it's really important when you're withdrawing money, if you don't qualify for any exclusions from New Jersey, you want to make sure that the CPA or accountant that you work with can write a letter to the IRS saying, no, 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 no. Peter and Paula, on their lifetime contributions to their retirement plan in the 401A, they already paid New Jersey state tax up to $1 million. Don't tax again when we take the money out. So that's also important to note too. Now, what I'd like to do is, and I know we're flying through this. I'm trying to keep it to 20 minutes here. This is fast and furious. I'm going to finish here on the scenario analysis, which is our tool to project different income scenarios. I think you'll find this valuable. So what's really neat about this software is we can take your tax return, we can upload it and create a base scenario for 2021. And then our clients can say, well, Greg, what would 2022 look like if we took the same information from the 2021 tax return and maybe changed one or two variables? So we can actually do that. And for a hypothetical, Paula came to me and said, well, Greg, my food blogging business is taking off. I want to retire from the university here in 2022. What would that look like? So as you can see here, instead of making $300,000 here in 2021, well, Paula wouldn't be working in 2022. So therefore, Peter would only be bringing in $150,000 from the university. Great. And let's say that Peter and Paula, they really want to increase their overall value of their wealth by trying to save on taxes today because they realize they're in a very low tax bracket now because Paula's not bringing in her $150,000. So what if we did what's called a Roth conversion? And instead of doing 10,000, we did 130,000 in 2022. So that will be a taxable event. They're basically paying their taxes now to potentially save on their taxes down the road. And we can quickly get an estimate of what that Roth conversion would cost. So on 130,000 of moving their IRA over to a Roth IRA, they would owe about, let's just call it $33,000 in change. We can print out a report here that can give us an idea of what would the net benefit be. So I'm not going to go through the whole report, but they have about 3.5 million between their 401As, their 403Bs, in what's called tax deferred assets. As we know, when it comes time to take that money out, they're not actually going to have 3.5. It's more closer, if you factor in taxes, 2.38 after tax. So they would owe about 1.1 in change in projected taxes on that amount. I'm not going to go through the whole report here. Let me just go down a bit. But we have a really nice graph that can tell us the break-even point of when doing this Roth conversion really makes sense and how much benefit can be realized by not touching this Roth IRA and letting it grow. So we could see here in 2048, approximately 26 years from doing the Roth conversion, that it starts to make sense. And even though Peter and Paula paid $33,000 in taxes today, if you look at over time, by 2059, they actually made an additional $279,000 on that Roth conversion. So not too shabby for paying $33,000 in taxes. So this is just a sample of some of the work that we can do with Roth conversions. We could do serial Roth conversions. So if we did one this year and we did 50,000 for the next 3 years, what would that look like? If you're thinking about selling your medical practice in 1 year, selling the home, if you're going to sell a patent that you own, we can factor this in and do some really tax smart planning. So we just covered a whole lot this evening. I think this will be a good time to answer some questions that you may have. So if you can click the Q&A box, we'll get to some of them. All right, so first question here. Is my modified adjusted gross income my adjusted gross income? Not necessarily. So as we saw before with Peter and Paula, their line 11, their adjusted gross income was actually different than their modified adjusted gross income. But for most clients, you'll probably see their AGI, we'll call it, is very close, sometimes if not the same as your modified adjusted gross income. However, there's a whole bunch of different modified adjusted gross income definitions for different things. And in order to calculate your modified adjusted gross income, you start with your adjusted gross income, that line 11 number, and you may have to add certain items on top of it. So for example, you may have to add a foreign exclusion interest that was excluded. You may have to add back municipal bond interest on top of your adjusted gross income to find your modified adjusted gross income. There's a bunch of different definitions. It depends on what you're looking at, but your adjusted gross income is not always the same as your modified adjusted gross income. So hopefully that answers your question there. Next question. Will my capital gains increase my marginal tax bracket? This is a really good one. So the answer is no. However, if you have more capital gains, it won't push you into a higher tax bracket. However, it will push up your adjusted gross income. So as we talked about before, the higher adjusted gross income, you'll be phased out of certain eligibility for contributing to certain retirement plans. You may be phased out of certain credits that you may qualify for. Otherwise, you may be hitting certain hidden taxes like IRMA, those Medicare surcharges, the net investment income tax. So the capital gains could ultimately lead to higher overall taxes, but it will not push you necessarily into a higher marginal tax bracket. So the way you have to think about it is how the tax code works is they first calculate your ordinary income sources. And what is that ordinary income tax? So let's call it anywhere between 0 to 37%. And then they'll take your capital gains and stack it on top of the ordinary income. And then that tax will be calculated separately at 0, 15, or 20% to find your overall tax picture. So great question, and hopefully that answers that for you. Let me pass on that. Okay. So that seems to be all the questions for this evening. And I think if anything, tax smart planning is really important. And unfortunately, a lot of academics don't realize that free advice is costing them a lot in terms of the value they could be receiving, as we can see tonight with just looking from a tax perspective at things. And if anything, you should be working with a financial advisor, a wealth manager who's reviewing your tax return every year and going through these different scenarios to make sure that there's nothing unturned and that there's additional dollars that may be able to be saved. And stay tuned for my next webinar, which will be coming out next month on the Prudential, now called Empower 457 plan. It's often not talked about enough on campus, but the 457 plan can be a tremendous savings vehicle that you can utilize. And if for some reason you'd like to catch the recording of this video and future webinars that I have and my new weekly videos that I produce every week, you can catch them on my YouTube channel, University Retirement Planning. Make sure you subscribe. If you'd like to get a great overall advanced view of financial planning and some of the more advanced techniques that are out there, please visit the Atlas Fiduciary Financial YouTube page. It's your smarter money. So once again, I hope you found this information valuable, and stay tuned for my next webinar next month. Until then, I hope you have a great evening. I'll see you soon. Take care.